Joining us this morning, Rosenberg Research President Dave Rosenberg. Dave, great to have you. We spent the last few minutes talking about some of this improving corporate sentiment, all-time highs. People are looking for some strong retail sales numbers this week. Are you able to poke some holes in any of those things?
All of it.
Well, I would say this much, that, if this was truly an earnings-driven rally in the stock market, the S&P 500 would be sitting at 4,600 right now, as opposed to 5,800 and change. So what's happened that I think is very interesting, and it just speaks to the animal spirits and the high degree of confidence that investors have. We've had a 4 multiple point expansion in the forward PE multiple just over the past 12 months. We're talking about a 2 standard deviation event. We've gone from 18 forward multiple a year ago to 22 right now. So that's really what the story is. It's earnings are still going up, but we're tracking maybe 5-6% year-over-year earnings growth for Q3. Stock market's up 34% over the past 12 months. So the price action in the stock market has outpaced the actual earnings momentum, call it by 8x, which when you look back at the data going back a century, that's a 1 in 10 event. That's what we're living in right now, a world that is extremely rare, but one where there is obviously tremendous exuberance, ebullience, and confidence, and that's what's driving the market higher.
If some of the activity comes in strong or continues to come in strong, do you think that hawks are deservedly worried about a repeat of inflation, or can you maintain your classic deflationary stance?
I'm not so sure it's going to reignite concerns over inflation because you can't just forecast inflation with one curve. You can't just do it through demand. You also have to have a view on what the supply side of the economy is doing. But the longer the economy stays strong, and I would question actually the veracity of a lot of the data that have been coming out. But if your view is that the economy is staying resilient or strong, in a 5% policy rate world, then what it has the Fed thinking is, where's neutral? And right now they think neutral collectively is 2 7/8. But what's going to happen is that the momentum is going to build that the neutral rate is probably quite a bit higher. Ergo, it's not so much about inflation, it's about that the Fed will not have to recalibrate to a lower neutral rate, as is currently thought. That neutral rate would be higher. So I think that's the challenge that's going to happen via what we'll see in the Treasury market going forward. So it's really more the impact on the neutral rate than it is necessarily on where inflation is going to be going.